Hello students, hope all of you are doing good. In this video, I would be covering direct tax amendments applicable for December 2023 exams, guys. So, as you guys are already aware of, just a clarification before I start with the amendments. Finance Act 2022 would be applicable for December 2023 exams, guys. See, already Finance Act 2023 has been affected. It has been applicable from 1st April 2023, but nothing contained in this will be applicable for your exams. So please be careful because a lot of changes have been brought through Finance Act 2023 in income tax, but nothing contained in that will be applicable for your exams, guys. I already clarified this even during my classes, but once more I am just clarifying it. Then the previous year applicable for your exams would be 22-23, or else the assessment year would be 23-24. So any changes made or any amendments which have been brought till 31st May 2023 would be applicable for December 2023 exams, guys. So in addition to whatever provisions I have already covered in my classes, that is in June 2023 exams, if there is any changes applicable in between June and December, I would be covering it in this video. So if you are my students who already attended my June 2023 exams classes, then this would be for you guys if you are writing in December. So here any changes or amendments I have highlighted in red color, and whatever reference I have given to the page number, here and there I have given reference to the page number. So that page number would be as per my regular study material, guys, so that it becomes easy for you to connect and study. So before I start, just guys make sure that you are having my study material in front of you. So if there is any small changes and all, you can update in the regular study material itself. So with this, we will start, guys. So wherever I have given reference, chapter, page number and all, it will be as per my regular study material. Yeah. First change is with respect to chapter 2.3, which talks about tax rates for different types of assessee for assessment year 23-24. Here, they have introduced a new concept of virtual digital asset, or in short, we call it as BDA. So, this is a special income for income tax purpose. We already have some special incomes like capital gains special income, then 115B, BB, all this talks about the special incomes. So even now they have introduced one more section called 115 BBH. What is it? Tax on income from virtual digital asset. Virtual digital asset here is nothing but like cryptocurrencies. As per the newly introduced section 115 BBH of Income Tax Act, the income in respect to transfer of, if you have transferred, means sold, the virtual digital asset in the hands of assessee shall be taxed at a flat rate of 30%. Without the benefit of any deductions except the cost of acquisition or set off of losses. So in simple, it is a special income. If you are holding any virtual digital asset and if you have transferred it, from that whatever income you have generated or profits you have generated would be straight away taxed at the rate of 30%, guys. It is a special rate and you cannot claim any chapter 6A deductions against it. Only deduction you can claim is the cost of purchase. That is the cost you have incurred to buy this virtual digital asset, and you can set off only the loss from the same nature. Means from the sale of virtual digital asset, if you have any loss, only that loss can be adjusted against the income of the same nature. Yes, this is all about the 115 BBH. So maximum they may ask you the question on the tax rate. So please be careful with it. Then coming to the third head of income, profits and gains from business or profession. So their fifth point, expenditure on scientific research. Come to page number 99. Yeah, the change is with respect to point B, guys, contribution to outsiders. So here, assessee, even though he is not engaged in scientific research business, he can contribute to someone who is engaged in research, that either scientific research, statistical research or social research, and he can claim it as his business expenditure. There are two categories of deductions here, guys. That is, assessee himself is doing research business. Yes, both capital and revenue expenditure he can claim it. But change is not with respect to that. Coming to point B, sir, I am not doing any research. I am doing some other business. but I have contributed to someone who is doing research. Can I claim it as a deduction? Yes. Where? Under the head PGBP only. Under the head PGBP itself means you can claim it as if it is your business expenditure. 100% deduction is given. When and also, so here, if you have given contribution to approved research association, college, institute or university for scientific research, 100% deduction. Then if you have given for the same category of person but for social science or statistical research also, 100% deduction. Then if it is for approved Indian company who is engaged in research and development for scientific research, 100% deduction. Then IIT National Laboratory, which is covered under section 35(2)(aa), scientific research under the program approved by prescribed authority, 100% deduction, guys. So the change is with respect to these 3 points. So wherever you are given donations to an approved association institution for doing any research, you can claim a deduction. But here now they have put a condition telling, what is it? Let us see. See guys, here whatever I have given only in red color is a change for you. Clear? So please be careful, sir. What about the content which is in black color? I have just taken it from my regular study material to give a connection. So nothing related to this black content, means the content which is in black color, there is no change with respect to it. And wherever I have given green color reference, means the amendment is with respect to that. Amendment is with respect to so and so point, guys. Clear? So you need not worry about any content which is in black color. I have just taken it from my regular study material to give a reference, that's all. So nothing related to the contents which are in black color is a change for you. Only observe or give importance to the contents which are in red color, guys. Yeah, so let us see. An amendment has been made in subsection 1A of section 35 of the Act to provide that deduction claimed by the donor, means whoever is giving the donation, with respect to the donation given to any research association, university, college or other institution referred to in clause 3A 3 or the company referred to in clause 2A of section 35 subsection 1 of the Act shall be disallowed unless such research association, university, college or other institution or company files the statement of donation. Means for whomever you are giving the donation, now for the first 3 category, only clause 2, clause 3 and clause 2A is covered. For whomever you are giving the donation, they should file statement of donation telling, yes, we have received the donation from so and so person, so much of amount. Only then the donor will be able to claim deduction under section 35 subsection 1, guys. If not, deduction will not be given for the person who has given the donation. Clear? Means only when the receiver is giving the proof that yes, we have received so and so amount from the respective person, only then the person who has given the donation can claim the deduction under the head PGBP. Yes. Next, coming to the 5th head of income, that is income from other sources. There, the 10th point, guys, that is with respect to gift taxation. Any money or value of property received without consideration or for inadequate consideration is subject to tax in the hands of recipients. Section 56 subsection 2 clause 10, one of the important section. So here, see, gift can be received in 3 forms, guys. Money, immovable property or specified movable property. If it is received in money, if aggregate value of money what you have received during the year from everyone, if it is more than 50,000, then entire amount would be taxable. Same way, if you have received any specified movable property, all movable property is not covered. Everything, all of this we already covered in detail in our regular class. So if you have received any specified movable property as a gift, then check the fair market value of it. If the fair market value of that specified movable property is more than 50,000, then entire fair market value would be taxable under this head, guys. Yes. Sir, what if I have purchased specified movable property but for inadequate consideration, means for a lesser value? In that case, first check what is the inadequate consideration. That is nothing but the difference between the fair market value and actual purchase value. If that inadequate consideration is more than 50,000, then the entire inadequate consideration would be taxable under this head, guys, in the hands of the buyer. Next, they have also talked about immovable property, which covers both land or building. Now, if any land or building is received as a gift and whose stamp duty value is more than 50,000, then entire stamp duty value would be taxable under this head. Yes, sir. Next, what if I have purchased land and building but for a lesser value? Then check what is the inadequate consideration. Inadequate consideration is the difference between the stamp duty value and the actual purchase consideration. And if that stamp duty value is higher than or more than either of the two things, if it is more than either of the two things, I repeat, if inadequate consideration, if you have purchased land and building for a lesser value, first find out inadequate consideration. That is nothing but the difference between the stamp duty value and the purchase value. If that is more than either of the two things, which is 50,000 standard amount or 10% of actual purchase value. If your inadequate consideration is more than either of these two, then inadequate consideration would be taxable under this head, guys. Yes, this is all what we already discussed in our regular classes. Now, for this, there were certain exceptions. Means in the following cases, sir, taxability is not applicable. That means section 56 clause 2, subsection 2 clause 10 will not be applicable. One is it, if you are receiving any gift, money or movable property or immovable property from any relative on the occasion of marriage of the individual or under a will or by way of inheritance or in contemplation of death of the payer or donor as the case may be, or from the local authority as defined in section 1020. All this remains the same, nothing changes. But now, there is a change with respect to point F and G, guys. I have highlighted that in green color. What is it? From any fund or foundation or university or other educational institution or hospital or medical institution or any trust or institution referred to in section 1023C, or from any trust or institution registered under section 12A. So if you are receiving any gift from so and so association or institution or trust, then section 56 to 10 will not be applicable, even though you have received free of cost or even though you have purchased for a lesser consideration. For this, they have brought some changes now, which I have given in the bottom. You can observe this point. Yeah, so this changes is with respect to F and G, which I have highlighted in red color, guys. Yeah, let me read it. A second proviso has been inserted to section 56 subsection 2 clause 10. It provides that exemptions under the first proviso to section 56 to 10 in respect of receipt of money or property from a trust or an educational institution referred above shall not apply if the property or money has been received by the persons referred to under section 13 subsection 3. Who are those? A person defined under section 13 subsection 3 include author or founder of the trust or the institution, a person with a significant contribution exceeding 50,000, any trustee of the trust or any relative of the above mentioned person, or any concern in which such person has substantial interest. Substantial interest means 20% or more profit sharing ratio or the shareholding, guys. Yes, means whoever has been mentioned here, guys, that is author, founder of the trust or institution, a person with a significant contribution more than 50,000, or any trustee of the trust or any relative of the above mentioned person or any concern in which such person has substantial interest. If these people are the receiver or recipients, and who are the giver? The giver are like fund, foundation, university, trust, hospital, educational institution. They are the one who is giving the gift, and the receivers are the following people. Then exemption is not applicable. Exemption is not applicable means, sir, will it be taxable in their hands? Yes, in the hands of the recipients, it will be taxable as per section 56 to 10, depending upon the value of the gift, guys. Clear? So, in the following cases, means if the following people are the recipients or the receivers, then they are not covered in the exemption list. Yeah, that means it will be taxable for them depending upon the value of the gift what they have received. This is the change with respect to this point, guys. So whatever amendment I have given is in red color. and this amendment is related to point F and G. That is why I highlighted point F and G in green color, guys. Clear? Yes. Then there is two more additions in the list, two more exemptions they have added. Means even in the following cases, section 15(6) to 210, 56 subsection 2 clause 10 will not be applicable. Which are those two cases? Any sum of money received by an individual, okay, receiver is an individual, from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family in respect of any illness related to COVID-19, subjected to such conditions as may be notified by the central government in this behalf shall not be the income of such person. Simple. Assume I have been tested positive of COVID-19. So I have taken any treatment for that purpose. Then any medical expenditure what I have incurred, if it is given by any other persons, like assume government, local authority, in that case, it will not be taxable in my hands. I am getting that money free of cost. Still nothing will be taxable. So in simple, not only mine, any of my family members also. So if any medical expenditure has been incurred for an individual or any of his family members for the purpose of COVID-19, if that expenditure has been incurred by someone else or reimbursed by someone else, then it is not taxable under the section 56 subsection 2 clause 10. Same to same provision even is applicable under salary aid. So assume I have taken the medical treatment for COVID-19 and my employer has reimbursed the expenditure or he has paid for the medical treatment. Even that is also not taxable under the salary head, guys. Clear? So in simple, if I have been tested positive, if medical expenditure is incurred for me or any of my family members, then if it is given by others, not by my employer, if it is given by others, we cannot tax it under their salary. Where should we check it? Under the other sources. Is it taxable, sir? No, nothing is taxable. Sir, what if it is given by my employer? Is it taxable? No, we have to check the head salary, but there also it is not taxable, guys. So medical expenditure for COVID purpose incurred by anyone for an individual or any of his family members is not taxable, guys. Next point they are talking about compensation. Assume a person has died because of COVID-19. He was tested positive and COVID-19 is the reason for his death. Now any of his family members are receiving the compensation. If his family members are receiving the compensation, who is giving it? You check. Either employer of the deceased person might be giving it, or any government authority or any charitable institution might be giving it. So whoever is giving that compensation for the family members who is receiving it, it is not taxable. It is not taxable, guys. Let us see. First one is medical treatment, J point. K is about compensation. Means person has gone forever due to COVID. Due to the death, a compensation has been received by his family members. Even that is not taxable, guys. Yeah. K, any sum of money received by a member of the family of a deceased person. Okay. Person has gone, so his family members are receiving the money. From whom? From the employer of the deceased person without any limit. Assume a person has died. Now due to COVID, his employer is giving compensation to his family members, then nothing is taxable, irrespective of the compensation, whether the compensation is 5 lakh, 50 lakh, 100 crore, whatever the amount, nothing is taxable, guys. If employer is giving to the family members of his deceased employee. Okay, sir, what if anyone else is giving? From any other person. If any other person is giving, or persons to the extent that such sum or aggregate of sum does not exceed 10 lakh. If anyone else, for example, a person has died due to COVID-19, for his family members, compensation has been paid by government, local authority, or any individual, or charitable trust, or Infosys Foundation, anyone else who is not an employer. Someone else is giving the compensation. In that case, it will not be taxable only if the compensation is up to 10 lakh. Sir, what if the compensation is more than 10 lakh? Then only difference is taxable. For example, assume a person had died due to COVID-19. Now, Infosys Foundation gave 15 lakh compensation to their family members due to this death. In that case, only 5 lakh would be taxable in the hands of the family members who is receiving it under the head other sources, guys. Yeah, condition. Where the cause of death of such person is illness relating to COVID-19 and the payment is received within 12 months from the date of death of such person and subject to such other conditions as may be notified by the central government in this behalf shall not be the income of such person. Shall not be the income means it will not be taxable. Okay. Condition is, yes, if death should be due to COVID-19 only. Sir, now I was tested positive, COVID-19 positive. Due to that shock, by heart attack, I died. So, was the cause of death due to COVID-19? No. It was due to some other reason. Now, assume a compensation is received by any of my family members. In that case, will it be exempt as per this point? No, because the cause of death should be COVID-19 only. Clear? And the compensation should be received within 12 months from the date of death. Sir, what if it is received after 15 months, 2 years, 3 years? Then this exemption would not be applicable, guys. And also, various other conditions has to be satisfied, like COVID-19 positive certificate has to be given, or if it is a reimbursement of medical expenditure and all means, even medical bill and all has to be submitted. This all about J and K point, guys. Actually, I had mentioned this point in my material, but I had given it in simple points. But now they have elaborated and detailed explanation has been given in the law. So accordingly, I have considered. See, you can observe in my material after this point, notes, after notes, it is there. After notes, there is note, come there. You can see I have mentioned amount received for medical treatment of COVID-19 or compensation received up to 10 lakh. On the death of the person is exempt and not taxable under section 56 to 10. Also not taxable as perquisite for employee under income from salary. This is what I had already mentioned in my material, but now detailed explanation has been given, guys. Okay, so this J and K is nothing but with reference to this note, guys. Clear? Yes. So we will march ahead. Coming to chapter 6, which talks about deductions from gross total income. Under that 7th point, that is 80DD deduction. Deduction in respect of maintenance including medical treatment of a dependent who is a person with a disability. Come on, guys. DD means dependent disabled. So your dependent has become a disabled, you are taking care of him, you are incurring all the medical expenditure for him or for her, or you have taken a life insurance policy for in his or her name and you are paying the premium. In that case, you can claim a flat deduction of 75,000 or 1,25,000 depending upon the severity. So if he is suffering from severe disability, 1,25,000, if not 75,000 every year, flat deduction, irrespective of the expenditure you have incurred. So now they have brought one amendment to tell you. What is it? I will just tell you. First, let us go through the B point here. Deduction is allowed in respect of any expenditure incurred for medical treatment, including nursing, training, and rehabilitation of a dependent, being a person with a disability, or paid or deposited any amount under a scheme framed in his behalf by the Life Insurance Corporation or any other insurer approved by the board for the maintenance of a dependent, being a person with disability. So this is the point which was already there. Means for your dependent who is suffering from disability, if you are taking care of him by incurring all the medical expenditure, or you have taken the life insurance policy on behalf of him or her and you are paying the premium, that means you can claim flat deduction of 75,000 or 1,25,000. And F point was telling point F, in case of a disabled dependent predeceases, means dies, the amount deposited in his name under a scheme framed in his behalf by the Life Insurance Corporation or any other insurer shall be deemed to be the income of the assessee in the year in which such amount is received. So what this point was telling is, assume I am taking care of my dependent brother who is completely dependent on me but disabled. So I am taking care of medical expenditure, I have taken life insurance policy in his name, premium I am paying. Now, every year I would be claiming a deduction of either 75,000 or 1,25,000 depending upon the severity. Now, a particular year he dies and I am receiving the compensation because preferably I would have named myself as a nominee. So once he dies, whatever insurance amount or policy amount we call it as, or sum assured, whatever I would be receiving on the death of a dependent brother who was disabled will be fully taxable for me. I cannot enjoy any exemption under section 1010D, guys. So it would be taxable for me. Okay. So these were the points which we already covered, nothing new in this. So whatever points I have highlighted in green color, now there is a change with respect to that point, which I have mentioned here in red color. What is it? An amendment has been made to allow the deduction under the said section also during the lifetime upon attaining age of 60 years or more of the individual or the member of HUF in whose name subscription to the scheme has been made and where payment or deposit has been discontinued. Further, taxability provision shall not apply to the amount received by the dependent before his death by way of annuity or lump sum by application of the condition referred to in the amendment. Sir, what is it? Guys, I gave my example. Assume I am taking care of my dependent brother who is suffering from disability. I had taken a life insurance policy in his name. Now my brother has reached an age of 60 years or there is an expiry of the term. So policy has matured. My brother is still alive. Policy has been matured. So who will be receiving the amount? My brother. Will it be taxable in his hands? No, it will not be taxable. Can he enjoy the exemption under section 1010D? Yes, my brother. He himself receives the amount, then he can enjoy the exemption under section 1010D. Now, what they have told in the amendment is, sir, policy matured. So now I will not be paying any premium in the future. So policy has matured, whatever a policy assume I had taken for 20 or 25 years. So now 20-25 years over, but still my brother is still alive who is dependent disabled. Now I'm not paying any premium in the future. Can I still continue to claim deduction under this section 75,000 or 1,25,000? Yes, I can still continue to claim it, guys. That is what the clarity is given here. Just because the insurance period got expired, so that doesn't mean that even deduction under section 80DD will stop. I can still continue to claim it, provided I am taking care of my brother. Taking care of means, so I am taking care of all his medical purpose, medical treatment, all other expenses, guys. Yeah. Next is chapter 7, TDS, TCS and provisions of advance tax. So we discussed about the tax on the transfer of virtual digital asset. Now, so with respect to the same, they have added one section in TDS to deduct TDS when a person transfer his virtual digital asset. What is it? We will see. 194, yes. Consideration for transfer of virtual digital asset. Transfer is nothing but sale, guys. When should we deduct TDS? When aggregate value is more than 10,000 in a financial year. Next, if the consideration is payable by a specified person, if a person who is paying it is a specified person and its aggregate value is 50,000 in a financial year, normal limit is 10,000, guys. But if the payer is a specified person, then the threshold limit would be 50,000. So who is specified person? I have mentioned here below that. Specified person means individual or HF whose accounts are not liable to tax audit under section 44AB in the preceding financial year. So he was not covered under section 44AB in the preceding financial year. Then an individual or HF who does not have any income under the head PGBP. So simple, an individual, both conditions has to be satisfied because in between and is there. An individual and HF who does not have any income under the head PGBP and he was not subject to tax audit in the last financial year. Then for him, if he is the payer, the threshold limit applicable would be 50,000 or it will be 10,000, guys. So who should be the payer? Any person. And depending upon who is this person, there is a threshold limit. Okay. Who is the payee? Any resident. Okay. Then what is the rate of TDS? 1% of the consideration. That is 1% of not profit, 1% of sale value. Please be careful. Tax rate is 30%. 30% of what? Profit. Where we were discussed in the tax rate chapter. Whereas here 1% of what? Sale value. Sale value we have to take. When TDS has to be deducted? At the time of credit or at the time of payment, whichever is earlier, guys. Yeah. Then, sir, what for the same transaction 194O as well as 194S, For the same transaction, both are applicable. Should we apply both the section or should we apply any one section? That is what the clarity is given here. Let us see. It is clarified that notwithstanding anything contained in section 194O, in case of O means online shopping, online purchase. In case of transaction to which the provisions of said sections are applicable, along with the provisions of 194S, which we just now discussed, tax shall be deducted under section 194S. Means 194S will override O, guys. So for the same transaction, now because even virtual digital asset you might be buying and selling through online, any platform, using any platform. So in that case, sir, will 194O be applicable or S be applicable? Yes, it is 194, yes, guys. Yeah, section 194O specifies that where sale of goods or provision of services of an e-commerce participant is facilitated by an e-commerce operator through its digital or electronic facility or platform. E-commerce operator is nothing but the platform through which we buy and sell, guys. Such e-commerce operator shall at the time of credit of the amount of sale or services or both to the account of an e-commerce participant or at the time of payment thereof to such e-commerce participant, whichever is earlier, deduct income tax at the rate of 1% of the gross amount of such sales or services or both. So 194O we already covered in detail in our regular classes. Whenever there is an e-commerce participant who is selling the goods or services through e-commerce operator like Amazon, Flipkart and all, then e-commerce operator has to deduct TDS at 1% on whatever sale value e-commerce operator has collected from the buyers and giving it to the participants, guys. So now there is no change with respect to O and all. It remains same like whatever we already discussed. But one clarity given here is for the same transaction, sir, what if both 194O as well as S is applicable? Which should be applied? It is 194 yes, guys. Clear? That is only if the transfer which is happening is of virtual digital asset like cryptocurrencies or Bitcoin and all. Yeah, let us move to chapter 9. Here there are few changes with respect to December 2023 exams. What is it? We will see. Chapter 9, assessment procedure. There is a new concept which has been introduced called updated return, guys. See, previously already revised return or belated return and all was there. So when can I file the revised return? See, return has to be filed within the due date, guys, including loss returns. Including loss returns. So we have seen already who has to file the return within what time and all. We already discussed in detail in our regular class. So the due date to file income tax returns is either 31st July of the assessment year or 31st October of the assessment year or the 30th November of the assessment year, depending upon the assessee, who is the assessee. Now, like for example, let me tell that also. So if the assessee is supposed to furnish transfer pricing report with respect to his international transaction, then the due date for filing returns is 30th November of assessment year. If the assessee is supposed to submit tax audit report, if his books of accounts is subject to tax audit, then the due date to file income tax return is 31st October of the assessment year. In all other cases, 31st July, guys. Then, sir, what if he doesn't file within this time? Then he can still file revised return. He can still file revised return within 3 months prior to the end of assessment year, that is on or before 31st December of the assessment year or completion of assessment, whichever is earlier. Sir, what if I already filed the return, but there was some mistake, omission or errors? Can I correct it? Yes. So this is why revision return is there. Then, sir, what about belated return? Even belated return. What if you cannot file the return within the due date? You can file belated return. The time limit to file belated return is also same like revised return, guys. So it is 3 months prior to the end of relevant assessment year, that is nothing but on or before 31st December of assessment year or completion of assessment, whichever is earlier. So there was already a provision to revise the return or to file the belated return. But now they have introduced one more concept called updated return. Sir, now have they removed a belated return and revised return? No, that is also there. Revised return as well as belated return, both are there. In addition to that, they have added the third one, which is called updated return, guys. Let us see what is it. Option to file updated return of income, section 139, 8, subsection 8A. Any person may furnish an updated return. Yeah, see, when I have given the heading itself is in red color, means entire topic is the amendment, guys. New topic. Clear? So here entire content I have not given in red color. I have given the heading in red color. That means entire topic is new. Entire topic is new. Yes. So let me start with. Any person may furnish an updated return of his income or the income of any other person in respect of which he is assessable for the previous year relevant to the assessment year at any time within 24 months from the end of relevant assessment year may be important. Yeah, within 24 months from the end of relevant assessment year. This is irrespective of whether or not he has furnished a return under section 139 subsection 1 or belated return under section 139 subsection 4 or revised return under section 139A, 139.5 for that assessment year. Means whether or not you have filed the return within due date or belated return or revised return, you can still file updated return, guys. For example, sir, I have not filed the return within the due date for the assessment year. Can I file the updated return? Yes. Sir, I have filed the return within the due date. Can I correct it now by filing updated return? Yes, you can do it. Next, sir, I have filed belated return. Can I update it? Yes. Sir, I have not filed belated return. Can I update it? Yes. Next, sir, I have filed revised return. Can I update it? Yes. Clear? So, in simple, whether or not you have filed the return, you can still update it. And what return it is. Okay. See, the point is very clear. They are told whether or not you have filed it, but at least you should have filed one return. Okay. Whether it is the return within the due date or belated return or revised return. So, see, to revise the return, you know that return should have already been filed. Only then we can revise it. But here what they are using the word, this is irrespective of whether or not he has furnished a return under section 139 subsection 1, that is within the due date, or belated return or revised return. That means whether or not you have filed the return in the past, now you can file updated return. This is what they are trying to communicate in this point. For example, updated return for assessment year 23-24 can be filed till 31st March 2026, guys. That is within 24 months from the end of relevant assessment year. Let us take it. So, guys, for you, previous year is 22-23. Yes, sir. Assessment year is 23-24. Agree? Yes. Sir, what is the due date to file the return within the due date? 31st July or 31st October or 30th November of the assessment year. If you have not filed it, then you can file belated return within 31st December of the assessment year or completion of assessment, whichever is earlier. Or else, if you already filed but now want to revise it, you can revise the return any number of times, but within 31st December of assessment year or completion of assessment, whichever is earlier. Now they are talking about updated return. When will the pre-assessment year end for you? 31st March 24. So from here within 24 months, guys. That means 31st March 26. So within 26 months, 24 months, you have to file your updated return. Is that clear? Yes. So it doesn't matter whether or not you have filed your original return within the due date or whether you have filed belated return or revised return. Any of the return you have filed, now you can update it within 31st March 2026, guys. Okay. Now, sir, can I update it in any scenario or under any circumstances? No, guys. They're allowing, the department is allowing you to file updated return only if it brings more revenue for them. Only if it brings more revenue for them. For example, please observe you. This is important. Sir, I have already filed my return in the assessment year. My tax liability was 10 lakh. My tax liability was 10 lakh. Now I want to file updated return where my tax liability would be 9 lakh. Can I file it? No. Because it will lead to loss of revenue to the department. They are not allowing you to file updated return. Clear? Yes, sir. Now, sir, what if my tax liability is increasing? Assume I am filing updated return where my tax liability would be 12 lakh. Yes, they are telling fine, you can file it. you can file it. Means if updated return leads to decrease in your tax liability, then you cannot file updated return. Only if it leads to increase in your tax liability, yes, you can file updated return. Same way, I am taking another scenario. Assume you had already filed a return. As per that return, the refund what you had already claimed was 3 lakh. Both cannot happen simultaneously. Okay. So now I am taking second scenario. You had already filed a return, either original return within the due date, revised return or belated return, any return you already filed. You have claimed a refund of 3 lakh. Now you want to update the return and claim a refund of 5 lakhs. Means there is an increase in refund. This will also cause a loss of revenue to the department. Will they allow you to file updated return? No, they will not. Sir, what if my refund is going down to 1.5 lakh? Will they allow me? Yes, they will allow you. So simple guys. If updated return leads to decrease in tax liability, they will not allow you to file updated return. But if it leads to increase in tax liability, yes, they will allow you. Same way, refund is reverse scenario. If there is any increase in refund due to filing of updated return, you cannot file updated return. But if there is a decrease in refund due to filing of updated return, yes, they will allow you to file it. So in simple, updated return is allowed to be filed only if it is bringing more and more revenue to the department. If it is causing loss of revenue to the department, they are telling, thank you, you cannot file updated return. Yeah, let us see. The provisions of updated return would not apply if the updated return of such person for that assessment year is the loss return. Means now, sir, can I file my loss return here? No. I had already filed my income return showing it, disclosing income of 3 lakh or 4 lakh. Now I want to file a return where I want to show loss. Can I do it? No, you cannot. So loss return is also not allowed. Then, as the effect of decreasing the total tax liability determined on the basis of return furnished under section 139(1) or 4 or 5 guys. Means you had already filed the return in which tax liability was more. Now you are filing updated return by decreasing your tax liability. Are you allowed to do it? No. Next, results in refund or increases in the refund due on the basis of return furnished under section 139 subsection 1 or subsection 4 or subsection 5. That means you had already filed a return where refund is 3 lakh. Now you want to claim more refund. Can you do it? No. Sir, or else, as per the return which I already filed, my tax liability was 1 lakh. But now, due to the updated return, I am claiming a refund. That means there is a loss of revenue to the department. Can I do it? No, you cannot. You cannot do it, guys. Next, circumstances in which updated return cannot be filed. Again, no updated return can be furnished by any person for the relevant assessment year. We have already seen 3 cases. Continuation of that. They have given some more scenarios. An updated return has been furnished by him under this subsection for the relevant assessment year. What is it, sir? See, for assessment year 23-24, you can file updated return on or before 31st March 26. Sir, I have already filed one. Assume updated return I have filed on 15 February 25. I have already filed updated return. Sir, can I file one more updated return? Assume it is on 10th September 25 within the time limit, but can I file one more updated return? No, it is not allowed. Only one updated return for one assessment year. That's all. You cannot file 2 updated return for the same assessment year, guys. Okay. Then any proceedings for the assessment or reassessment or recomputation of or revision of income is pending or has been completed for the relevant assessment year. In this case, means a case against me is pending. Department has initiated computation or assessment or reassessment of my income or revision of my income. So it is still going on or it is completed just now. Can I file an updated return for that year? No, you cannot. So these are the 5 cases, guys. Okay, totally 5 cases are there where you are not allowed to file updated return. Then the last point here is such person or belongs to such class of persons as may be notified by the CBDT. Means they are allowed the CBDT to extend this list in the future. As of now, there is only 5 points. 5 scenarios where updated return cannot be filed, guys. Fine. Next, if any person has a loss in any previous year and has furnished a return of loss on or before the due date of filing the return of income under section 139 subsection 1, he shall be allowed to furnish an updated return if such updated return is a return of income. Sir, for assessment year 23-24, I have already filed my loss returns. Now I want to file an updated return, which is the return of income for assessment year 23-24. Am I allowed to do it? Yes. If you have filed a loss return, now you want to disclose income, that means you are allowed, because your tax liability will accordingly go up. Example, if Mr. X has furnished his return of loss for assessment year 23-24 on 31st May 2023, consisting of 5 lakh as business loss, he can furnish an updated return for assessment year 23-24 up to 31st March 2026 if such updated return is a return of income. But vice versa is not possible. Sir, I had already filed a return of income. Now can I file updated return of loss? No, that is not allowed. They are mentioned here. Agree. But here what they have mentioned is, sir, I had already filed my return, which is a loss returns. Now can I file an updated return, which is a return of income? Yes, you can do it. Fine. Next. Last paragraph here. If the loss or any part thereof carried forward under chapter 6 or unobserved depreciation carried forward under section 32 subsection 2 or a tax credit carried forward under section 115 JD is to be reduced for any subsequent previous year as a result of furnishing of updated return of income for the previous year. An updated return is required to be furnished for each such subsequent previous year also. Sir, what is it? Assume guys, for previous year 22-23, I had already filed a return in assessment year 23-24. Okay, I had already filed a return, sir. Assume it was a loss return of 3 lakh. It is a loss return of 3 lakh. Now I have updated it. I have updated this return. And somewhere assume on 31st January 26, I have updated it. And it is a loss of 1 lakh. Yeah, yes, or it's just a second. I will keep it as income because this has to be income. Yeah. Assume I have disclosed the income of 5 lakh. So now loss of 3 lakh has become an income of 5 lakh. Now this updated return for which year I have filed? Assessment year 23-24. Will this have an impact for assessment year 24-25 also? Yes, because whatever loss you have, you would have carried forward for next year and you would have adjusted in the next year. So this will impact even the assessment year 23-24. Yes, sir. So you have to file updated return even for assessment year 24-25, guys. Means within what time, sir? Within 31st March 27. Clear? So in simple, due to filing of updated return, if any unobserved depreciation or if any loss or any AMT credit, that is alternate minimum credit, if that is getting affected for next year also, if that is getting affected for next year also, and for this year you already filed return, for this year you already filed returns, in that case even for this year you have to update your return, guys. Clear? I repeat once again because there might be a confusion here. See, assume you already filed return for assessment year 23-24 for a loss of 3 lakh and you also already filed a return for even assessment year 24-25, that is next year. Now, within the time limit given for updated return, you are updating the return for assessment year 23-24 by disclosing the income of 5 lakh. Now, within this time, that is the time when you are filing the updated return for assessment year 23-24, you already filed the return even for assessment year 24-25. You already filed your original return. But due to this updated return, the figures of assessment year 24-25 also will get affected. So what should you do? As you already filed the return for this, you have to update the return even for assessment year 24-25 within 31st March 27, guys. That is within 24 months from the end of relevant assessment year. Okay. Sir, what about the tax? Should I pay tax while filing updated return? Of course, you have to pay. What is the amount of tax, sir? You have to pay tax along with additional tax. Tax is there along with additional tax, sir. What is it? Let us see. Tax on updated return, section 140B, completely new provision. Payment of tax, additional tax, interest and fee before furnishing updated return of income in case where no return is furnished. You are not at all furnished a return in the past. Now you are straight away filing updated return. See, actually name itself is updated return. When do you update something? When you already given some information, now you are updating it. But there is a scenario we discussed here, whether or not you have furnished the return in this paragraph. Whether or not you have furnished the return in the past, now you can file updated return within 24 months from the end of relevant assessment year. Now, under the first scenario, they are talking about you are not at all filed the return in the past. So now you are filing the updated return. Then what is the amount you have to pay? Where no return of income under section 139 subsection 1 or subsection 4 has been furnished, because they are talking only about original return and belated return. Revised return, you cannot revise something, you cannot revise the return if you are not at all filed the return. No question of revising the return if you are not at all filed the return, guys. So you have not filed any original return also, you have not filed belated return also. That means you have not at all filed any return. Okay. Has been furnished by an assessee and tax is payable on the basis of updated return to be furnished by such assessee under section 139 subsection 80, the assessee would be liable to pay such tax together with interest and fee payable for any delay in furnishing the return or any default or delay in payment of advance tax along with payment of additional tax computed under section 140B subsection 3 before furnishing the return. Let me take the example. So please be attentive, especially with the numbers. Guys, for assessment year 23-24, I was supposed to file the return. I am not at all filed. Now I am filing the updated return. Okay, sir. As per updated return, my tax liability assume is 10 lakh. My tax liability is coming to 10 lakh. Should I pay it? Yes. Before filing updated return, I have to pay this 10 lakh plus interest because there is a delay in payment of tax. So you are liable to pay interest and all. So assume interest is coming to, I'm just randomly taking the amount. Interest is coming to 2 lakh and late fee for delay in filing the returns and all. Okay, the late fee will be there. Everything put together, I am taking 12.10 lakh. So 10,000 I have considered late fee. Clear? Yes, sir. Or else let me take 5,000. Why 10,000? When we know it. Yeah. 5,000. So 12 lakh 5,000 is the total amount I am supposed to pay. Plus there is an additional amount, guys. There is an additional amount. What is it? We will see later. Clear? I will repeat this once again. For assessment year 23-24, I am not at all filed my returns. Now I am filing my updated return within the time limit. So as per updated return, my tax liability is 10 lakh. Then for delay in payment of tax, the interest is 2 lakh. Then late fee is 5,000. Totally, I am liable to pay 12 lakh 5,000. So only when you pay this, you will be allowed to file updated return along with additional amount. Along with additional amount. What is that additional amount is given in subsection 3. We will discuss it later. Fine, sir. Next, subsection 2. In case where return is furnished earlier, tax to be paid along with the interest before furnishing updated return. Where a return of income under section 139(1) or subsection 4 or 5 means you have filed any one of this return. Okay. Revised anyway. You can do revision only if you have filed original return. So in simple, guys, you already filed some return. Now you are updating that return. Has been furnished by by an assessee and tax is payable on the basis of updated return to be furnished by such assessee under section 139 subsection 8A. The assessee would be liable to pay such tax together with interest payable for default or delay in payment of advance tax along with payment of additional tax computed under section 140B subsection 3 before furnishing such return. Sir, what is this? Assume guys, I am taking second example this side. For assessment year 23-24, I had already filed my return. I had already filed my original return within the due date. As per that, my tax liability was 5 lakh. As per that, my tax liability was 5 lakh, which I have already paid and filed the returns. Okay, sir. But now I am filing updated return. Within 24 months from the end of assessment year, I am filing updated return. As per updated return, my tax liability is coming to 12 lakh. But how much I have already paid? Reduce that much. Already paid. Because in my original return, I have already paid 5 lakh. So how much is the difference? 7 lakh. As there is a delay in payment of 7 lakh, so there will be interest and late fee charge. Interest plus late fee, assume it is 1 lakh. I am just taking random figures. I am not doing calculations of interest and all. Yeah. So now you are supposed to pay how much? 8 lakh. Before filing updated return, you have to pay 8 lakh guys, along with additional amount. There is an additional amount also you have to pay. What is it? We will see. Just a second. So additional amount also you are liable to pay. What is it? We will see. I will just repeat the scenario. I had already filed original return where my tax liability was 5 lakh. I have paid that and I have filed original return. Now I have filed my updated return. As per updated return, my tax liability is coming to 12 lakh. Means there is an increase in tax liability. Yes. So only then they will allow you to file. Yes, sir. So I have already paid 5 lakh. So again, I will not be paying it. We will reduce it. Then as there is a delay in payment of 7 lakh, I would be levied an interest under section 234A, B, C. There will be different interest which will be levied. So interest, late fee, everything put together, assume it is coming to 1 lakh. So totally I have to pay now 8 lakh before filing updated return plus an additional amount guys. Plus an additional amount. What is that additional amount? Now we are yet to discuss it. Please pay attention. An additional amount, additional income tax payable at the time of updated return. The additional income tax payable at the time of furnishing the updated return under section 139 subsection 8A would be, means whatever you are liable to pay, you have to pay that. In addition to that additional amount guys. In addition to that additional amount. Please be careful. Okay sir. What is it? We will see. If such return is furnished after the expiry of the time available under section 139.4 or 139.5 of the assessment year or before the completion of the period of 12 months from the end of relevant assessment year, then what is the additional income tax you are supposed to pay? 25% of the aggregate of tax interest payable as determined in one above. Okay. Next, what is it? Let me explain it by trying a timeline. Guys, assessment year 23-24. What is the deadline to file belated return or revised return? 31st December of the assessment year. This is the deadline to file belated return or revised return or the completion of assessment, whichever is earlier. So we will take this only as standard date. Fine. So when will this assessment year end? 31st March 24. Sorry, this is 31st December 23, not 24. Yeah, come on guys. For assessment year 23-24, what is the deadline to file belated return or revised return? 31st December of assessment year. And when will the assessment year end is? 31st March 2024. Assessment year will start on 1st April 23. Okay. They're telling first point is like this. If such return is furnished after the expiry of the time available under section 139.4 or 5, means time limit for belated return and revised return is over. If it is not over, you can file belated return only or you can file revised return only. Why will you file updated return? Agree? Yes, sir. because you can save additional tax, because when you are filing belated return or revised return and all, there is no additional tax and all. Maximum there will be a late fee, that's all. Yeah. And before completion of period of 12 months from the end of relevant assessment year, that means, sir, within 12 months from year 31st March 24, means you are filing belated updated return within this time, guys. You are filing updated return, shit, not 24, it is 25. Yeah. So within 31st March 25, you are filing the updated return. So within this 12 months, if you are filing updated return, then the additional income tax is only 25%. So 25% of what? So in this example, so it will be 25% of 12 lakh. 25% of 12 lakh. Because whatever tax liability, this is the first example what I have taken. I had not at all filed any return. Now I am liable to pay tax 10 lakh plus interest 2 lakh plus late fee 5,000. So I will take 12 lakh into 25% of it. 12 lakh into 25% of is only 25% of tax liability and interest, guys. Okay. They have not mentioned late fee here. Please be careful. Yeah. So it will be that much. So totally you will pay 12.05 lakh, that is 12 lakh 5,000 plus whatever amount you get here. Is that clear? Yes, sir. Sir, what about as per this example? I had already filed my return. So as per the return, I already paid 5 lakh. Now I am filing updated return. As per that, my tax liability is 12 lakh. I already paid 5, so I will reduce it. Remaining is 7 lakh plus. Let us take only interest. There is no late fee. I am just assuming. So interest is 1 lakh. So totally I am paying 8 lakh. In that case, what is the additional amount I have to pay? It is 8 lakh into 25%. Not entire tax. Whatever you are paying now due to updated return, 25% of that you have to take. Not 25% of 12 lakh. Please be careful. So 8 lakh into 25% plus 8 lakh. You have to pay it, guys. Clear? Assuming there is no late fee, only interest and tax. Is that clear? Yes, sir. Next, sir, what if I file the return after 12 months but before 24 months? If such return is furnished after the expiry of 12 months from the end of relevant assessment year, but before the completion of the period of 24 months from the end of the relevant assessment year, then what is the additional amount? 50% of the aggregate of tax and interest payable, guys. So for example, here, what is the deadline to file updated return? 31st March 26. Okay. So I am filing the updated return within this time, guys. After 12 months, but before 24 months. In that case, what is the additional amount? 50%. Here, if it is 25%. Is that clear? So simple, you already know, na? From the end of the relevant assessment year, we have totally how much time? 24 months. But the additional amount is different. If you file it within 12 months from the end of relevant assessment year, then 25%. If it is after 12 months but before 24 months, then it is 50%. Yeah. So as per this scenario, what will be my additional tax in both this example? First example. So what is the additional amount you are liable to pay? 50% into 12 lakh. That means you have to pay 12 lakh 5,000 plus 12 lakh into 50% as your tax. Only then you can file your updated return tax. And this is called what? Additional tax. This is what normally you are liable to pay, but they are asking you to pay something additional tax. Additional tax is nothing but in the form of penalty, guys. They are just leaving you a penalty for allowing you to file updated return. Yeah. Sir, what about this example? As per this example, it will be 8 lakh into 50%. That comes to 4 lakh. So only when you pay 8 lakh plus additional tax 4 lakh, that is come to 12 lakh. Only when you pay 12 lakh, you will be allowed to file updated return, guys. Is that clear? Yes. Yes. For the purpose of computation of additional income tax, tax would include surcharge and cess by whatever name called on such tax. Means whatever figures I have taken here na tax liability, it is the final tax liability, guys. After it says, after surcharge, everything. Here also. Whatever tax liabilities I have considered, it is after all the cess, means 4% cess and surcharge if applicable. Okay. Then the interest payable would be interest chargeable under any provisions of this act on the income as per updated return furnished under section 139 subsection 8A as reduced by interest paid in the earlier return if any. So whatever interest you are liable to pay, there are few sections, okay, like 234A, 234B, 234C, which levies interest. So whatever interest you are liable to pay, we have to consider that also. If you already paid some interest, we will reduce it. We will reduce it. Yeah. Note. An updated return furnished under section 139 subsection 8A would be regarded as defective return as referred under section 139 subsection 9 unless such return of income is accompanied by proof of payment of tax as required under section 140B, guys. Means before filing updated return, you should have paid tax, and that payment proof of that payment should be attached to your updated return. Only then it will be considered as valid return. If updated return is filed without the proof of payment of tax, then it will be considered as defective return, guys. Clear? Yes. Sure. Next, next change is with respect to PAN. Come to page number 228. We already seen the list of people who are supposed to obtain PAN or who should have PAN, guys, like person whose income is more than basic exemption limit, or person whose sales or turnover is more than, from business or profession, more than 5 lakh, or if it is a trust or a charitable institution, or if person is entering into any financial transaction of 2,50,000 or more, or any person who is the face of it, they should have a PAN. Now this list has been extended to add some more people who are supposed to have PAN as per the rule. So whatever I have highlighted in red color is a change here. Further, for widening the tax base, every person who has not been allotted a PAN and intends to enter into such transaction as prescribed by the CBDT is also required to apply to assessing officer for allotment of PAN. Means if you are willing to enter into any of these transactions, then for you PAN is mandatory. Means before entering the transaction, you should have PAN. In simple, at the time of entering this transaction, you should have PAN. Here means if you are willing to enter into any of this transaction, before entering the transaction, apply for PAN, get it, and at the time of transaction, give it to the opposite person. So accordingly, rule 114BA has been inserted to prescribe the following transactions. What are those? Every person who intends to deposit cash in his one or more accounts with a banking company, cooperative bank or post office, if the cash deposit or the aggregate amount of cash deposit in such accounts during a financial year is 20 lakh or more. Means in a year, if you are depositing 20 lakh or more, not only one time, throughout the year, if your total deposit is 20 lakh or more, then before entering into the transaction, means at least 7 days before the date on which he intends to deposit cash over the specified limit, that is of 20 lakh or more, he should have obtained the PAN. Means he should make an application. At least 7 days before that, he should make an application. Same way, every person who intends to withdraw, first was deposit, now it is withdraw, cash from his one or more accounts with a banking company, cooperative bank or post office, if the cash withdrawal or aggregate amount of cash withdrawal from such accounts during the financial year is 20 lakh or more. So here also you have to make an application for PAN at least 7 days before the date on which he intends to withdraw cash over the specified limit, guys. So in simple, let me see, it may not make sense so much. Why? Because now you cannot have a bank account without PAN and Aadhaar and all, but still they are telling you, assume you have an account where you are already deposited on 10th June, you already deposited 10 lakh. Now on 15th September, you have deposited another 8 lakh within 20 lakh. Now on 25th December, you want to deposit another 5 lakh, guys. So your total deposit is exceeding 20 lakh. Yes, sir. On what day? 25th December. So on 25th December, you are willing to deposit another 5 lakh. So on this day, it will cross overall aggregate limit 20 lakh. So 7 days before this, at least make an application for PAN and you should have obtained PAN on or before 25th December. Means at the time of depositing, you should have PAN in simple. So at least 7 days before this, you should have made an application for obtaining PAN and get the PAN, and at the time of depositing, please give your PAN. Clear? Yes. Same way for withdrawal. If you are withdrawing 20 lakh or more from, sir, what if I have multiple accounts? All accounts put together, it is 20 lakh, not for each account. And 20 lakh is not single deposit or single withdrawal. It is throughout the year. Please be careful. All your accounts put together. Then any person who intends to open a current account or cash credit account with a banking company or a cooperative society or a post office, then before opening, at least 7 days before the date on which he intends to open such account, he should have applied for PAN. Everywhere 7 days is the limit. See, there is a chances that you may get confused with these points with respect to, because even who are supposed to file the returns mandatory, there also they have given some point with respect to deposit, but there the deposit is exclusively in the current account. Please be careful. Clear? Who are supposed to file the returns and all, there also some monetary limit and all is there. Please don't get confused with that and this. This is for those who should apply for PAN, who should have PAN. They are talking about them. But in our regular class, we already seen who should file the returns mandatorily. Don't get confused with this list and that list, guys. That is for filing returns mandatorily, and this is for getting PAN mandatorily. Okay. Accordingly, Rule 114BB has been inserted to prescribe that every person has to, at the time of entering into a transaction specified above, quote his PAN or Aadhaar number, as the case may be, in documents pertaining to such transaction, and every person who receives such document as to ensure that the said number has been duly quoted or and authenticated. So what are they trying to tell? Means you should apply for PAN at least 7 days before the deposit or withdrawal or opening the current account or cash credit account. Yes, sir. And here, as per Rule 114BB, they are telling at the time of deposit or withdrawal or at the time of opening the current account, you will be filling some forms. In that forms, you are supposed to give your PAN number. Means indirectly they are telling on the date of transaction, you should have your PAN. And they are also telling the person who is doing the transaction with me is who? Banking company or cooperative bank or post office. It is their duty also to collect it. Collect my PAN or Aadhaar. Note, quoting of PAN or Aadhaar number is however not required in case where the person depositing money or withdrawing money or opening current account or cash credit account is central government, state government or consular office. If these are the people concerned, central government, state government or consular office means foreign embassy, if they are the one who is depositing or withdrawing the money or opening the current account or cash credit account, for them this provision is not at all applicable. This provision is not at all applicable, guys. Is that clear? Yes. Sure. Let us move to the last point, that is with respect to Aadhaar. Quoting of Aadhaar number, section 139AA, page number 230. Here also, whatever I have given in red color is the only amendment, guys. Okay, because I have given a reference to whatever we already covered in regular class, but you need not worry about it. Let me just go through some background, only then I will go through the changes. Yeah, what is it, sir? Every person who is eligible to obtain Aadhaar number shall quote Aadhaar number mandatorily. Where? In the application for allotment of PAN, because they will directly link PAN and Aadhaar there itself. Then in all the income tax returns. Note, where the person does not possess the Aadhaar number, the enrollment ID of Aadhaar application form issued to him at the time of enrollment shall be quoted in the application for PAN or in the return of income. Yes, sir. Now, intimation of Aadhaar number. Every person who has been allotted permanent account number as on 1st July 2017 and who is eligible to obtain Aadhaar number shall intimate his Aadhaar number to the prescribed authority on or before 31st March 2022. Means you have to link your Aadhaar with PAN on or before 31st March 2022, which is already over. Okay, this was the deadline which was given to link Aadhaar with PAN. It is mandatory to quote and link Aadhaar number while filing the return of income either manually or electronically unless specifically exempted. Sir, they gave me a deadline to link my Aadhaar with PAN. What if I don't do? What will they do? That is what they are told. Consequences of failure to intimate Aadhaar number. If a person fails to intimate the Aadhaar number, the permanent account number allotted to such person shall become inoperative after the date so notified in the prescribed manner. This is what was already there, guys. Clear? So we also covered this in our class. Now they have mentioned this manner. In what manner PAN will become inoperative if you have not linked it before 31st March 2022. That is what the change is. Okay, so the changes with respect to this, let us see. As per the proviso to section 139AA subsection 2, in case of failure to intimate the Aadhaar number, PAN would made inoperative after the date so notified. What is that date? 31st March 2022. In such manner as may be prescribed. That's what we already covered. Now they have prescribed that manner. In what manner PAN will become inoperative? Let us see it. Rule 114(a) specifies the manner of making PAN inoperative. Sub-rule 1. Date from which PAN will become inoperative. Where a person who has been allotted PAN as on 1st July 2017 and is required to intimate his Aadhaar number under section 139 AA subsection 2 has failed to intimate the same on or before the due date, that is the 31st March 2022, that was the deadline given. The PAN of such person shall become inoperative and he shall be liable for payment of fee specified under section 234H, read with rule 114(5)(a). And even that fee also we already seen. You can observe you. Where a person who is required to intimate his Aadhaar number under section 139AA subsection 2 fails to do so on or before the notified date, that is 31st March 2022, he shall be liable to pay such fee as may be prescribed at the time of making intimation. So what is that fee? 1000 rupees. The amount of late fee was 1000 rupees. Okay. Means, sir, can I link my Aadhaar with PAN even after 31st March 2022? Yes, you can do, but only after paying a late fee of 1000 rupees. Okay. Next, sub-rule 2. When and how inoperative PAN can become operative? Means, sir, what if my PAN has become inoperative? Will it be inoperative forever? No, you can make it operative by linking it. Where the person has intimated his Aadhaar number after 31st March 2022, after payment of fee specified under section 234H, which we saw just now, 1000 rupees, his PAN would become operative within 30 days from the date of intimation of Aadhaar number. Means, once you give your Aadhaar number, link it with PAN by paying a late fee of 1000 rupees, within 30 days, your inoperative PAN will become operative. Means, inoperative doesn't mean that it is completely dead and done. You can still make it operative provided you link it by paying a late fee of 1000 rupees. Sub-rule 3. Further consequences of failure to intimate Aadhaar number. A person whose PAN has become inoperative shall be liable for further consequences, namely, means once your PAN has become inoperative, all these consequences you have to face it. What are those? A person whose PAN has become inoperative shall be liable for further consequences, namely, refund of any amount of tax or part thereof due under the provisions of the Act shall not be made. Means if you are eligible for any refund, it will not be processed for you. Then interest shall not be payable on such refund for the period beginning with the date specified and ending with the date on which it becomes operative. Means even though you are eligible for refund and the refund has been delayed due to your PAN has become inoperative, you will not be eligible for any interest on your refund. Then where tax is deductible in case of such person, such tax shall be deducted at a higher rate in accordance with the provisions of section 206 AA. 206 AA will tell when payer is supposed to deduct TDS, payee has to give his PAN. If payee doesn't give his PAN, then that payer will deduct TDS at the rate of actual rate or 20%, whichever is higher. So if payee's PAN has become inoperative, it is as if he is not having PAN. So payer has to deduct TDS at what rate? Actual rate or 20%, whichever is higher. Then where tax is collectible at source in case of such person, such tax should be collected at a higher rate. in accordance with provisions of section 206 CC. Even 206 CC, which talks about the TCS, if the seller, means if the person who is supposed to collect TCS, for him, if the other person is not giving the PAN, then TCS has to be collected at higher rate. So if PAN has become inoperative, it is as if he is not having PAN, so TCS would be collected at a higher rate, guys. So this all are the consequences, negative consequences. It is more of negative consequences which a person has to face once his PAN has become inoperative. Then date from which consequences specified in rule 114 AAA would become effective, means from what day all these consequences you have to face. Is it from 31st March 2022 only? No. Rule 114 AAA sub-rule 4 provides that the provisions of sub-rule 3 shall have effect from the date specified by the board. Accordingly, the CBDT has wide this circular specified that the consequences specified above will be effective from 1st July 2023 and would continue till PAN become operative by intimating Aadhaar number. A fee of 1000 rupees will continue to apply to make the PAN operative by intimating the Aadhaar number. What is it, sir? Simple, guys. Now, what was the deadline for you to link your Aadhaar with PAN? 31st March 2022. They're telling till 31st. Sorry, first, 30th June, let us take. Yeah. So, till 30th June 23, negative consequences will not be applicable. Whereas from the next day itself, 1st July 23, negative consequences will start. Agree now? So negative consequences will start only from 1st July 23. Sir, what is the meaning of this? If you have linked your Aadhaar on or after 1st April 22 till 30th June 23, you have to pay a late fee of 1000 rupees. You are supposed to pay a late fee of 1000 rupees. But till here, there is no negative consequences. There is no negative consequences. Sir, what if I am linking my Aadhaar on or after 1st July 23, you have to pay late fee of 1000 rupees under section 234H plus negative consequences also you have to face. You also have to face a negative consequences. Okay, sir, when will I come out of the negative consequences? Once you have linked your Aadhaar with PAN by paying 1000 rupees extra fees within 30 days. Within 30 days, as per this point we have seen now. Within 30 days, your inoperative PAN will become operative. Means from the day your inoperative PAN become operative, yes, all these negative consequences also will be resolved. Clear, guys? Yes. Last line. However, these consequences of PAN becoming inoperative shall not be applicable to those persons who have been provided exemption from intimating Aadhaar number. So, hope you guys understood. I will just quickly repeat this. See, deadline to link Aadhaar was 31st March 22. Sir, can I link it even after that? Yes. If you are linking it on or after 1st April 22 till 30th June 23, you can link it without any negative consequences, but by paying a late fee of 1000 rupees. Sir, what if I link it on or after 1st July 23? Then you have to face negative consequences till your PAN is operative. That is, till your inoperative PAN become operative. You have to face negative consequences. Then you can still link your Aadhaar by paying a late fee of 1000 rupees. Till you pay and link it, you have to face the negative consequences. Sir, when will I come out of negative consequences? Is only within 30 days of becoming your inoperative PAN operative. Clear? Once you link your Aadhaar by paying a late fee, then within 30 days your inoperative PAN will become operative. From the day your inoperative PAN become operative, you will come out of the negative consequences. And here they are telling, last paragraph, however, these consequences will not be applicable for the person who have been exempted from Aadhaar authentication. Means we already seen this, the following people are exempted from Aadhaar authentication. For them, Aadhaar authentication is not mandatory. That means, will they have to face negative consequences? No. When we have given exemption for them not to link their Aadhaar, then why will we apply negative consequences for them? Who are those people, sir? The central government, effective from 1st July 2017, notified that the provisions of section 139AA relating to quoting of Aadhaar number would not apply to an individual who does not possess the Aadhaar number or enrollment ID, and is, means they don't have Aadhaar, and is residing in the states of Assam, Jammu Kashmir and Meghalaya, a non-resident as per Income Tax Act 1961, or is age of 80 years or more at any time during the previous year. That means your previous year. And is not a citizen of India. So for the following people, Aadhaar authentication was not at all applicable. So if they are not done, will we apply all these negative consequences? No, guys. Clear? Yes. This is all about the amendments applicable for your December 2023 exams, guys. Hope this session was useful for your preparations and your preparation is going on in full swing, guys. Guys, don't lose hope. Especially those students who couldn't clear your exams in June 2023, that is group 1. I know what is your feelings, what you might be undergoing. Guys, all these are common for professional students, including me. We all have undergone through this process. We have all undergone through this process, nothing new. Please make sure that, yes, whatever has happened cannot change anything, but you have to learn something out of it. What has gone wrong from your point of view, try to correct them. That's all, guys. So please don't lose hope. Be strong. Definitely you will be able to do it. Guys, there is no one who has achieved success without tasting failure. Everyone has to taste failure, and you guys have to be happy that you have seen failure very early on. Instead of seeing at the end, somewhere here only you have seen. So now you have to learn from your mistakes so that you will not repeat it again in the upcoming exams, guys. Only 2 more exams are pending for you guys. It is executive and professionals. You cannot do it, huh? Definitely you can do. You would have already written and passed hundreds of exams from your school days. These are only 2 exams you have to pass it to make your life more beautiful and worth. Guys, you will do it. Come on, you push hard, give your 100%. Only 2 more months are left. So this 2 months should be the most productive months in your life. Only then you will get the results which you are expecting, guys. So all the best for your preparation and exams. Do well, guys.